This is Bloomberg Technology. Coming up in the next hour, tech stocks stumble with mounting concerns about trade and global growth. We'll talk about the continued fallout for Silicon Valley. Plus, trade truce extension. President Trump is hinting that if 90 days don't cut it to finalize a deal with China, there could be more time available. And we look at China's goodwill efforts with an attempt to stop IP theft. And Apple hits shuffle on its marketing department. The iPhone maker is trying to boost sales of its flagship iPhone with rarely seen discounts and extra staff. First to our top story, tech stocks fell the most in 2 weeks Tuesday. Concerns mounting that the U.S. and China will not make any meaningful breakthrough when it comes to trade negotiations and IP protection. Meantime, investors are rattled by worries over global growth at a time when central banks around the world pull back their support. What could rising rates mean for tech investors? Joining us to discuss from New York, Weedon & Co. Global Chief Strategist Michael Purves, along with Bloomberg News cross-asset reporter Sarah Ponczak. So, Sarah, first of all, if this trade truce doesn't happen, what does that mean for tech?
Well, you would think that if it doesn't happen, then we would continue to see what we have seen over the past 2 months or so. Many people were saying that part of the sell-off was indeed because of these trade tensions, everything going on between the U.S. and China. And we had seen Apple really take a hit, semiconductors, a lot of tech stocks that do have a lot of exposure to China, sales in China, or products that are made in China. So yes, over the weekend, many investors are saying that was a step forward, an incremental positive. However, at the same time, it's really just delaying it 90 days. So we have to see what happens over the next 90 days. But if really nothing changes, we might continue to see some of the weakness that we've seen recently.
Apple shares taking another hit on news that yet another supplier has cut its sales forecast, Cirrus Logic, which makes audio parts for the iPhone. That said, Michael, tech isn't just one thing. Apple's problems are different from Facebook's problems, are different from Amazon's problems. So what do you think the different narratives are that are driving the overall one?
Yeah, I think it's a great question and a great point, because I think there's a lot of stuff going on through all this volatility that, really started after the NDX and the tech, made those great highs in the late summer. They've obviously, had some of the most severe damage, but they're kind of supposed to. If the market is in a de-risking mode, the beta that you have implicit in the XLK ETF or the QQQ ETF is supposed to have, magnified return to the downside there. And so I think, then you have the whole bond market story and well, geez, are we at a late cycle situation where people are really structurally rotating out of tech frantically and are going to stay rotated out of it? And I think the answers here are somewhat nuanced. My view personally is that I think the quality and the quantity of the earnings growth that many FANG stocks have done is probably going to continue into 2019 and 20, and there will be support for that. If global growth is slowing down, however, there are, like Cisco, for example, right, a very large liquid name that's been a great performer over the last 3 years, but that obviously has been a classic GDP, a global GDP proxy. That will obviously be exposed. Companies like Microsoft will be more exposed. The trade war is yet another wrinkle in this whole discussion because, its impact on Apple may be more about supply chains. Its impact on an Amazon or Google may be more about market opportunity being pushed back.
Now, Sarah, I've got a chart here in my Bloomberg, which basically shows you that the tech-heavy NASDAQ is lagging the S&P. And I'm curious, what does this say about how believable the recent rally in tech actually was?
So what this chart is showing you is the percentage of companies in both the S&P 500 and the NASDAQ 100 that have now come above their 50-day moving averages. So as you can see, it isn't quite as much for the NASDAQ 100. So you have more companies in the S&P 500, a larger share, that are really taking a larger leg higher as compared to the NASDAQ. So what it's showing you is, yes, you have large names like Apple, Amazon, your large cap names that might be adding more. But if you look across the board at some of the large cap tech names, they're really not increasing or having those gains as quickly as some other areas of the market. A lot of people have been looking at areas like healthcare or staples or utilities. If you look at tech, NASDAQ, yes, we have seen a leg higher the past couple days, but maybe it hasn't been quite as across the board as we've seen in some other areas of the market.
Now, Michael, what about interest rates? If interest rates continue to rise, what does that mean for tech and Silicon Valley?
Well, I think it's a great question because, tech, you could draw a chart of the NDX over SPX with bond yields, and there was a pretty obvious co-movement of those two lines over the last few years where, if interest rates were reflecting a weaker economy, people wanted to be overweight these tech names there because they had economically insensitive growth. I would argue, though, that prospectively, when you think about it, a lot of these companies have minimal exposure to rising interest rates. There's an argument about the cost of their cost of equity going higher with a higher cost of risk-free rates there. That's a little bit more theoretical, but from a sort of visceral point of view and from how is this going to impact earnings? Like on the face of it, these companies are often negatively levered or very conservatively levered, huge cash balances there. And for some of them, their earnings are benefited by higher rates and all that. And but I think there's another component here, which is that a lot of these companies, particularly within FANG, they don't have those. They're not exposed to an unemployment rate driving up wage cost issues. Facebook's average wage is in the hundreds of thousands of dollars. They don't care about the U3 rate and the Phillips curve, right? Their business models work through extraordinarily high wage pressure since they were founded. So, I think in a certain respect, if in a higher rate, later cycle environment, the earnings quality may well hold up in many of these names because, again, so many of these big names are less economically sensitive because it's more about disruptive business models taking market share from old economy businesses.
What about for private companies? I mean, we've seen tech startups, late-stage growth startups raising hundreds and hundreds of millions of dollars, and venture capital funds raising billion dollar plus funds bigger than ever.
Yeah, I mean, look, in terms of when these companies actually go, some of these private companies, very prominent ones going public, we've been sort of waiting for that to happen. And I think there's certainly some of them are very comfortable not going public until they're well and ready. No one wants to be that busted IPO, certainly there. And look, these choppy markets, which are probably, in my expectation, likely to last through the winter, that doesn't help the IPO environment. There'll be some that will come out, but I think, if you're an investment banker coaching your client on when to go public, you probably want things to firm up a little bit, and particularly to, get a sense for whether this rotation issue is it really stabilizing or not. But people will, those IPOs will be at one point there'll be a great window to go public. It's just probably not in the immediate future.
All right, there you have one prediction that the choppiness will continue. Wheaton & Co. Global Chief Strategist Michael Purves with us, as well as Sarah Ponsek for Bloomberg News. Thank you both. Coming up, we look at how regulators are tackling big tech, both here and in Europe. Our exclusive conversation with Vasant Dar of the Stern School of Business is next. And if you like Bloomberg News, check us out on the radio, listen on the Bloomberg app, Bloomberg.com, and in the U.S. on SiriusXM. This is Bloomberg. In Europe, a major plan to tax large tech companies from Alphabet to Facebook was kept on life support Tuesday. In the final hour, France and Germany proposed a compromise, scaling back the broad plan initially envisioned by Paris. Bloomberg's Maria Tadeo reports from Brussels.
In Europe, the French and German government have come together to put forward a plan to tax digital companies. Under the new plan, companies of the likes of Facebook and Google would have to pay 3% of their advertising revenue come 2021. They won't, however, have to pay on data sales. Earlier, I spoke to the French Finance Minister, Bruno Le Maire, who told me American companies are welcome in Europe, but they must pay their fair share. Let's take a look.
Those important American companies are most welcome in France and everywhere in Europe. And many of those companies have announced a few months ago that they would invest more in France. So I think that this is a very clear signal that we are willing to host those companies and to let them invest in Europe. They are most welcome, but they have to pay their due taxes as all the other companies do.
And while the plan is still ongoing, it must still be ratified by European nations. Sources close to the negotiation tell Bloomberg News it will most likely happen at the start of 2019. Maria Tadeo, Bloomberg News, Brussels.
And when it comes to regulating online content, my next guest has some ideas. He recently wrote an op-ed for The Hill entitled "What Lawmakers Need to Do to Police It." Vasant Dar is a professor of information systems at the NYU Stern School of Business. He joins us now from New York. Professor Dar, let's start with what the EU is looking into here, getting more and more pressure to look into these ad-based business models of Google and Facebook. Margaret Vestager has an investigation into Google's AdSense. In particular, how much do you think these ad-based business models are really under threat?
Well, they certainly need to be examined. This is a very opaque marketplace. When you compare these ad exchanges to financial exchanges, which are incredibly transparent, we really have very little idea as to what goes on behind the scenes in these ad exchanges, especially when a major player owns both sides of the relationship. I mean, they own they've got tools for the publishers, they've got tools for the advertisers, they've got the exchange, they've got the major part of the volume. So there's a lot of opacity in this process, and I think what the European regulators are trying to get to is just sort of get to the bottom of it and see whether it's anti-competitive. That's kind of what the initial fine against Google, Frugal, was all about. And the truth is that there is a lot of opacity, that these companies can change their algorithm very suddenly, and suddenly it alters the ranking quite dramatically. So it's not surprising at all that the regulators want some more transparency into what really goes on in the ad market, in the online ad market.
The business models potentially hurting competition is one thing. Do you also believe they're a risk to society?
That's a great question, and what a difference a year makes. A year ago I was writing about the need to regulate social media platforms because of the risks that they posed, and this was before all of the bad stuff really emerged. And I was making this argument just based on the fact that the science showed that you could manipulate people at scale, you could do it cheaply. Things had begun to smell even then that that there was something not quite right with this ecosystem. And then that was followed by months of denial, that this was ridiculous, nothing like that could have happened, followed by, oh geez, this really did happen, to like, we're sorry, and now, some kind of a belligerence. So, if there's one thing I would advise these media companies, social media companies, is a little contrition might actually go a long way and be better than belligerence, because clearly they do pose certain kinds of risks. We don't understand them completely yet. This is a completely new era we're in, where these platforms have huge audiences and huge powers that can be used to persuade people, and the algorithms are neutral in the sense that they'll just target very accurately without regard to who's doing the targeting and for what. And that's the kind of thing that we need to understand a little more carefully. And some of the proposals I've been making around measurement are just oriented at, we can't understand something we can't measure. So let's just try and, get some ways of measuring, what the hell is going on in this this whole ecosystem.
Professor, the range of online content is vast. Obviously there's Facebook and Google on one end. You in your op-ed mention Gap.com, a social network which trumpets itself as a free speech protector. This is where the Pittsburgh synagogue shooter reportedly used this website a lot. What should lawmakers do in these situations? How should they actually measure, as you say, and police this?
Well, the first order of business is just to understand what's going on out there. Like, what do people think about it, right? We've got no real ways of measuring any of this stuff at the current time. One of the things I proposed a year ago was that we should have KYC kinds of regulation in the social media space, and we're moving towards that. But my thinking is that I think anonymity might just also be a thing that's going to disappear, because that just causes all kinds of problems, right? I mean, you need.
So, do you think Twitter should require real names?
Well, I mean, I wouldn't be surprised if a year or two down the road we're talking about people being required to authenticate themselves, right? Are you who you really say you are? Because without that, it's just very difficult to know who's saying what, why they're saying any of this stuff. And it's a really delicate kind of issue, right? On the one hand, you want freedom of speech, so you want people to be able to say whatever they want. On the other hand, you do need to be mindful of the risks that such an ecosystem poses to democratic processes, to an open society. And open societies are particularly vulnerable, much more so than heavily regulated countries and authoritarian regimes who don't need to worry about this. We really need to. So, there are great risks to this. And, I've got more questions than answers, and I'm just taking a stab in the direction of some of these answers, like KYC, or having a gauge by which you can actually measure what people are saying and what other people think about that, right? I mean, it's...
Professor, we'll have to leave it there. We could certainly debate this for hours. Definitely worth checking out that op-ed in The Hill. Vasant Dar of NYU Stern School of Business. Thank you so much for weighing in. Well, from the court to investing, we'll speak to the Golden State Warriors star turned tech entrepreneur Steph Curry on why he is betting on a travel startup. And Bloomberg Technology, we are live streaming on Twitter. You can check us out at Technology and follow our global breaking news network TikTok on Twitter. This is Bloomberg. Morgan Stanley warns that FedEx and UPS face underappreciated competitive risks from Amazon Air. The bank cut estimates for volume growth, revenue growth, and discounted cash flow for both package shippers. That sent shares of FedEx and UPS lower Tuesday. Amazon has been building up its freight delivery service this year. Steph Curry disrupted basketball by making seemingly impossible three-point shots look routine. Now the Golden State Warriors guard is looking for disruptors in business as he scouts out new investments off the court. The NBA's highest paid player is bulking up his investment portfolio of tech companies. And his latest bet is a Toronto travel startup, Snap Travel, which he says is destined for success. Curry caught up with Bloomberg's Natalie Wong in Toronto. Take a listen.
Obviously, being in the Bay Area, being in Silicon Valley for the last 10 years, it's all about, obviously relationships and kind of expanding ourselves. And, part of my team have kind of been on the search in terms of, companies that are being disruptive and having obviously success. And in terms of Snap Travel and where they are in conversational commerce and finding ways to meet the consumer where they are, and in terms of, again, being disruptive in that industry. It said a lot about the company, about the leadership, and definitely excited to be a part of the team.
You came on at a relatively early stage for the company for its Series A funding round. What type of value do you think you bring as an investor to the table?
Hopefully a lot in terms of obviously using my platform to bring attention and awareness to the company and exactly what it can offer. There are a lot of things around my brand and things around the philanthropic world and media space that hopefully can help boost and amplify the things that Snap Travel are already doing well. And just I love to be hands-on with things, and in terms of just trying to bring added value any way that I can, and being available. That's something that we try to bring to the table as well.
Right. You've made a variety of investments in different companies, from Pinterest to Slice and now Snap Travel. What's your investment philosophy?
It's continuing to grow, but in terms of just looking obviously at founders and their track records, we want to try to make sound judgments and build that credibility and sustainability early in our investment strategy. And in terms of finding companies that have strong market traction, doing our due diligence, and really the approach that I have on the basketball court in terms of trying to be the hardest workers in the room. That's something that's very important in terms of trying to be successful early and continue to sustain it.
Right, you've obviously had a process that's made you arguably one of the best basketball players so far, but what's your process when it comes to investing and making strong business decisions? Walk me through that. Like, how do you make that decision?
Well, first, just obviously a synergy to basketball. You surround yourself with the right people that are, again, smarter than me in terms of pointing me in the right direction. But in terms of, again, being detailed at the beginning, doing our homework, doing our research, getting educated on the industry that we're investing in, and being smart with our money, that's something that's very important.
Do you see yourself as more of a risk taker, or do you have a more conservative approach when it comes to making big bets in the market?
I'm probably somewhere in the middle. I want to obviously take some chances and expand myself, but obviously you gotta make sound judgments and make sure that you're again doing your homework and aligning with the right people. I think the power in leadership and how important that is in the process of building strong, sustainable, successful companies is something that is first and foremost.
Many former basketball legends have become really savvy business investors, from the Admiral or Magic Johnson. Who are some former players that you turn to for advice, obviously outside of your father?
That's the fun part about playing where I get to play. The network out there is amazing. When you go to our games, you kind of look around the courtside seats. It's major VCs, major corporation CEOs, and things like that. So the network is strong. In my 10 years there, I could have a long list of people that I've run in, whether it's a simple conversation or follow-up meetings and things like that, where you just learn. And in terms of, like you said, veterans in the game that have been really successful, you named two of them so far. In terms of, I've had sit downs with Dave Robinson for sure, in terms of what he's doing in the philanthropic space as well. Obviously, I know how successful Magic is and what he does in his ventures, but there's plenty of guys that have done it well. I'm trying to do it my way, but obviously lean on some of that advice as well.
That was Golden State Warriors star Steph Curry speaking to Bloomberg's Natalie Wong in Toronto. Up next, China is taking steps to punish people who steal intellectual property. Will it be enough to satisfy the White House? And here's something you don't often see associated with an iPhone: a discount. Will Apple's latest marketing moves be enough to win over holiday shoppers? This is Bloomberg. Bloomberg Technology, I'm Emily Chang in San Francisco. Over the weekend, Presidents Trump and Xi came to a 90-day trade truce. Now, in a series of Tuesday tweets, Trump hinted that he could extend that period of détente. This comes after the president tweeted that he had secured an agreement from China to reduce or eliminate tariffs on U.S.-made cars, but then his top economic advisor, Larry Kudlow, told Fox News that deal isn't finalized. Kudlow did say he expected China to lower its auto tariffs. Take a listen.
The president expects, I think he's right, he's going to get it, they will take their car tariffs down to zero. They were 15%, then they were knocked up to 40 as a retaliatory move, and I think you'll see pretty soon they'll be knocked down to zero. That's my guess.
To discuss in New York, we've got Isaac Stonefish, Senior Fellow at the Asia Society, and in Washington, Sarah McGregor, who heads Bloomberg's coverage of U.S. economic policy. And Sarah, all of this happening as the White House is meeting with German automakers. Many observers say who would benefit more than U.S. automakers from some of these potential changes, if indeed they happen. What is the status of these car tariffs or lack thereof?
So yes, we had the heads of some German automakers meeting at the White House today with Trump administration officials. They emerged from the meeting, and of course, their message is not that they're here to advocate for trade. The EU, of course, is in charge of that, but that they came to tell Trump about their plans, that they might be able to expand themselves in the U.S. And I'm sure that auto tariffs did come up, and that would be a disservice to their companies who they do want to import into the U.S. But I think their larger message was there's potential here for more U.S. investments in car production, even by European companies. So let's not scuttle that relationship.
So, Isaac, The Chinese haven't said anything about this at all. They have not commented on the president's initial tweet, nor have they commented on the backtracking. What do you make of that?
I'm having a real tough time figuring out just what is actually going on. My best guess is that they didn't really agree to anything on Saturday night except an agreement to keep talking, and then Trump felt either desperate or impulsive for a deal. The U.S. side put out a list of things that they wanted to get out of it or they thought they got out of it. You had this bizarre Trump tweet on Sunday, I think it was, about the tariffs that Kudlow then had to walk back. And I think the markets and outside observers and possibly the Chinese themselves are scrambling to try to understand what exactly is Trump's play here, and if this is something that he's planned or if this is just impulse and error.
One of the president's most memorable tweets of the day so far: I am a tariff man. When people or countries come in to raid the great wealth of our nation, I want them to pay for the privilege of doing so. It will always be the best way to max out our economic power. We are right now taking in billions of dollars in tariffs. Make America rich again. Sarah, aren't American taxpayers paying these tariffs?
There are companies in the U.S. that, of course, are complaining, who import from China, that these tariffs are hurting them. China, of course, has issued retaliatory tariffs, so again, being hit by those. And the Trump administration would argue it's added billions of dollars into the coffers, but as you said, it also comes to a cost for U.S. businesses. And I think that's the key marker now as we look ahead to these 90 days. What impact are the tariffs having on the economy? Trump sort of has a few more months to assess the data and see really if these trade headwinds that a lot of economists are predicting are sort of taking hold just as the tax cut effect peters out and sort of this global momentum shifts a little bit.
Now, on this intellectual property theft issue, Isaac, I've been dying to get your thoughts on this. The Chinese government has now laid out 38 different punishments to be applied to various IP violations. You know, how significant is this? What counts as a violation, and will the government actually enforce it?
So right now, all we can say is that it's a positive step. It's really, really hard to know whether or not the government will expend the political capital that it needs to enforce it. And my guess is that for some really egregious cases of brands being ripped off, they'll make a big show about taking those down. But for companies like Huawei, a national champion telecommunications company, I'd be very shocked to see them say, oh, Huawei, you're accused of stealing US IPR in this case, this case, and this case, so we're actually going to punish you according to the new regulations.
But the range of potential IP violations is broad, right? Chinese citizens coming to work at U.S. companies, then going back to China. I mean, walk us through all of the potential issues around IP theft and what this actually addresses.
So I think what this actually addresses is it gives Beijing the opportunity to say, you guys have a big problem with IP. We are doing something on it. Here's a concrete list of what actually we're doing. But there's such a huge disconnect often in China between the letter of the law and its implementation. And there's also a big issue, there's an old Chinese expression, the mountains are high and the emperor is far away, with Beijing's ability to control the having trouble with that word, the implementation of something like this in further away regions from Beijing. So we do have 38 specific steps that they say they're going to take, but I would be shocked if we have this conversation in 3 months and find that they've actually taken a lot of those steps.
So, Sarah, that said, is this going to be enough to appease the administration?
So this IP issue that Isaac was just discussing is obviously the high watermark for any deal that Trump is going to reach. Achieving that in 90 days sounds almost impossible. Just last month, the USTR released a report that said, China has not responded to any of the Trump administration's demands to address these IP issues. It, of course, was the basis for the tariffs to begin with in July. And so I think the Trump administration, if they totally ignore this issue, which is going to be the most difficult to to tackle will be sort of going too easy on China in terms of the bar that it set. Larry Kudlow told us yesterday, the White House economic advisor, that they were pretty close to a deal on IP with China. But again, it's hard to take the Trump administration at its word on this so far, because it has sort of backtracked and flip-flopped a bit on what was exactly agreed at the dinner. And we're sort of led to believe at this point that China and the U.S. might not be on the exact same page on this.
All right, lots to continue to break down. Sarah McGregor of Bloomberg News, Isaac Stonefish of the Asia Society. Thank you both. Meantime, Apple suppliers' woes continue. On Tuesday, Cirrus Logic joined Lumentum and Qorvo as the latest supplier to tumble after cutting its forecast following worries over future iPhone demand. Shares of Cirrus, which makes audio parts for the iPhone, fell by as much as 6% in early trading before recovering some of that loss. In LA, to tell us more about this and what Apple is trying to do to sell more iPhones, we've got Bloomberg's Mark Gurman. So, Mark, you discovered some pretty aggressive moves that Apple is taking, ranging from discounts in a way to reshuffling its marketing staff. Just how much is the iPhone this year discounted?
So to be clear, they're not actually cutting prices per se. They're advertising a lower price, which makes this so interesting. They're advertising the iPhone XR as $300 less than it actually costs. Now, this is a marketing tactic you might see from Samsung or Huawei or some of the carriers like Verizon and AT&T. But this is a new type of effort for Apple. This is not something we've seen from them basically disguising the price or saying that the price is something that it's not. In reality, this is a trade-in deal that they're boosting. So this is a new aggressive tactic, and it was sort of unbelievable to me following Apple for so long, going to their homepage, Sunday night and seeing a banner for this $300 discount that's not really a discount at the top of the page.
Right, certainly rare. You just don't think about banner ads and discounts associated with the iPhone. However, those discounts are being delivered. Now, talk to us about the marketing shuffle. They've put additional staff on, trying to make sure they're getting more iPhones out the door.
So about a month ago, they shuffled some of their marketing resources, some of their staff on the marketing teams at Apple in what one person called a fire drill. Reallocating those resources to focus on new ways to market the iPhone and boosting iPhone sales in light of all these concerns in recent weeks and months about the iPhone's prospects for the holiday season.
So talk to us about these continued supplier cuts. Are the alarm bells getting louder?
Yeah, we've heard this all before with the iPhone X, and it turned out the iPhone X did quite well. It was their best seller on a weekly basis. Apple continued to say the iPhone unit sales weren't that bad across 2017 and 2018. The problem is that all these fears are being compounded by the fact that Apple's no longer going to reveal their iPhone unit sales. So at this point, the truth obviously is important, but Apple's not going to come out and correct the record. They already said they're not going to do that. Quite frankly, that takes to some people to mean that the days of iPhone unit sales growth is over. Perhaps they'll turn back to that when unit sales continue to grow again, but we'll really find out what it means based on the revenue numbers as well.
I do have this chart here in the Bloomberg showing Apple's continued dependence on the iPhone. It's gone up. It's gone down slightly more recently. And of course, we've been talking about how Apple's trying to make this transition to a services company, but that the iPhone is still going to be incredibly important. Meantime, we talked yesterday about how the company is making a bet that 5G won't be a big deal next year. They're waiting till potentially 2020. And yet AT&T, we have learned, is working on a phone with Samsung that will have 5G connectivity and be ready for next year. How much of a threat is that to Apple?
So in years past with the iPhone 3G and the iPhone 5, they missed the boat by 1 year on 3G and 4G LTE respectively. It didn't matter because 5-10 years ago nobody really cared about any other high-tech phone other than the iPhone. These days the competition is so much higher, and Samsung you're going to see having about a 1.5 year head start on 5G. It's a network technology that's going to be more heavily marketed. But I want to touch base on the services company transition for a second. Apple's been trying to pivot investors to look at services, and I quite frankly find the notion that they're pushing this a little bit ridiculous because the services have to run on something, right? And services growth has been tied to the growth of iPhone hardware. So at some point, they're going to have a new piece of hardware to run these services on for that growth to continue on both the services and the hardware front.
Right. It's all about the continued growth of the Apple ecosystem. Do you think we're going to be getting more supplier cuts? I mean, there's companies that we haven't heard from yet.
Right, and the careful balance has to be there between what is related to an Apple supplier and what could be said about, Samsung's own issue selling phone, because the smartphone market overall is reaching a point of market saturation where growth, not only for Apple but across the board, is slowing. The interesting one today with Cirrus Logic is that in their most recent filing with the financial institutions, they say that 82% of the revenues come from Apple, right? So that is a big chunk of their revenues. That's the most I've seen from any supplier to be, dedicated to a single company. It's not great for their business and their shareholders, of course, but that is, indicative proof that this is an Apple-related problem.
80% of revenue from Apple. That's reliance, if we ever saw it. Bloomberg's Mark Gurman, thank you, as always, for stopping by. Now, turning to the world of hacking, the National Republican Campaign Committee said it was hacked and that the FBI is now investigating. A spokesperson wouldn't elaborate on which officials or systems were targeted or whether there's any indication of who was behind it. Popular question and answer website, meantime, Quora, also says it recently discovered around 100 million of its users had their data compromised. This was due to the unauthorized access to one of its systems by a malicious third party. Users may have had account information, including email addresses, encrypted passwords, compromised. Quora says it made the discovery Friday and has notified law enforcement officials, in addition to retaining a digital forensics and security firm to assist. Wells Fargo expects to spend $9 billion on technology this year, about $800 million of that going specifically towards cybersecurity. Wells Fargo CEO Tim Sloan also told a Goldman Sachs financial conference that the bank is on track to achieve its expense targets and that net interest income will be up this year. Coming up, robo-advising software company Wealthfront wants to automate all of your finances. How it is using AI and machine learning to create equal access to financial planning next. Plus, Tesla's most bullish analyst calls its factory an overcrowded mess. Why he says this may be a sign of hope, however, for the electric car maker. This is Bloomberg. Online money manager Wealthfront is using tech to level the financial playing field. Since 2011, the financial advisory startup has used a combination of AI and machine learning to cut out the middlemen and provide answers to over 10,000 financial questions instantly. In the last year, the company says it's delivered real-time advice up to 50 times as many clients as a human financial advisor could handle in an entire year. Today, Wealthfront announced it is opening up automated planning services to anyone for free. Here to discuss, CEO Andy Rachleff. So what's actually changing here?
Well, for the last couple of years, we've offered automated financial planning to our investment service clients, and we've had such a great experience with that. Namely, what we found was that our clients who used our automated planning saved 5% more of their income than people who didn't. So over one's lifetime, that's another $1.25 million. And we looked at that number, and given the crisis of savings these days, we thought that shouldn't be behind a paywall. We wanted everybody to be able to get access to that kind of financial planning.
So then how do you make money?
Well, we make money on our investment management service, we make money on our lending service, and in the future we'll have other financial services. But if you really like our planning, you're always welcome to open up a Wealthfront account.
Now, there are more and more big traditional companies from Vanguard to Charles Schwab that are doing what you do. How do you keep up with that?
Well, actually, they follow us. We don't keep up with them. So what they all do is a very thin layer of software that does asset allocation, which is a very simple thing to do. As a matter of fact, it only took us 4 engineers 3 months to build that back in 2011. What we've built since then is far more advanced. We've built many advanced investment services that we make very simple, inexpensive, and automated. We do automated financial planning, which none of those people do.
So do you think that machines can do a better job here than in every respect, or are there things that humans will always have to do when it comes to asset allocation?
You know, that's a really interesting point, in that there have been numerous studies that have shown that data leads to better decision than expert opinions. And so in every case, what we do is we use data to make the decision as opposed to the expert opinion. And that's certainly true in financial planning.
So then do you see a lot of jobs going away as a result of the rise of this kind of technology?
Interestingly, a lot fewer people are going into financial advice in financial planning, because I think that young people realize that's not what they want. As a matter of fact, our clients tell us, we pay you not to talk to us. It's a generational change, and as a result, many fewer people are going into the industry. So I don't think it's so much jobs will be lost, but I don't think that it's going to grow. And look, there's still travel agents. They just serve older people and more complex situations.
Now, you were one of the co-founders of Benchmark Capital back in the 90s, so you have seen, you know, many trends, the rise of many companies and various trends in sort of wealth management. What is some sort of smart advice, smart decisions that you believe that your technology is making that maybe other companies aren't offering?
Well, because we are dedicated to delivering everything through software, we've positioned ourselves to deliver on our ultimate vision, which we like to call self-driving money. And what I mean by that is, in the next year or so, you're going to be able to direct deposit your paycheck with us. We will pay your bills, not give you a bill pay system, but we'll literally pay your bills and then route the remaining money to the most appropriate account, whether inside of Wealthfront or outside of Wealthfront, depending on your personal situation and goals. That's not possible to be done with people. It's only possible if you do everything through software. And we've tested this idea on many people, and they say, when can I have that? It just takes a lot of development to get there.
Self-driving money, it certainly sounds good. We will be watching. Andy Rachleff, CEO of Wealthfront and co-founder of Benchmark Capital. Thank you so much.
Thank you for having me.
Still ahead, 2018 saw both delivery and production problems for Tesla, but one analyst is bullish as ever. He'll join us next. This is Bloomberg. It's been a year of controversy for Tesla, but the company's most bullish analyst is as bullish as ever. After taking a tour of the electric car maker's factory in Fremont, California, Pierre Ferragu from New Street Research has reaffirmed his $530 price target for Tesla, well above the average $327. This even as he describes the factory as a crowded mess, having spotted a scrap conveyor belt system and unused production capacity. Ferragu, the global head of tech infrastructure for New Street Research, joins us now from New York. So, Pierre, why the price target so high despite what you saw?
Well, because that's really what I would call, the Tesla method, or even the Elon Musk method. You aim for very high, and you fail on your own internal objective, and you achieve something absolutely amazing. So the reason why this factory feels like a mess is because it's very packed. There wasn't enough room to produce that many cars. Initial plans were extremely ambitious in terms of automation, in terms of the density of automations. I've never seen a place with that many robots packed in that environment. And of course, like, the initial plan didn't really play out fully as planned. The company had to build a tent to add a third assembly line. The company was delayed. A lot of tasks that were initially planned to be automated ended up being manual. But still, the factory is exceptionally efficient. The day I was there, I could see over 5,000 cars, cars being manufactured at over 5,000 a week in terms of cadence. And so,
exceptionally efficient. Elon Musk has talked about how hard it is to be a car company in general, and yet, you say exceptionally efficient. You've got owners who love their cars. There is this fervent following. Clearly, there is demand. Do you think at a certain point it becomes easier for Elon Musk and for Tesla to be that car company?
Yes, and I think this is exactly the moment at which we are today. 2019 is the year it becomes easier. So how does that become easier? When you look at the Fremont factory manufacturing like at a cadence of 5,000 cars a week, it's actually still a lot of downtime. They just need to accelerate a bit that factory to manufacture 7,000 cars a week. Then the next step for Tesla is to accelerate the ramp of their assembly lines in China. That's going to be much easier. They have learned a lot from what they've done in Fremont, and they're going to build much more efficient factories, a much more efficient factory there, and they're going to be able to ramp production there relatively rapidly. And last but not least, Tesla produced 56,000 Model 3 in Q3, and with a gross margin of 22%. So of course these cars were sold only in the US. They were sold at a very high price tag, average price selling price of $56,000. And in 2019, Tesla is going to increase volumes. It's going to expand beyond the US market. It's going to introduce leasing options to make the cars more affordable. All that is going to expand the company very significantly. And of course, what I expect to expand with that is actually margins. And that's the one thing the investment community is missing at this point. I think Tesla can be a double-digit margin operations exiting 2019.
Okay, Pierre Ferragu, a bright future, according to you, for Tesla and Elon Musk. We'll have to leave it there. New Street Research Global Head of Tech Infrastructure, Pierre Ferragu, thanks so much for stopping by. That does it for this edition of Bloomberg Technology. We're live streaming on Twitter. Check us out at Technology. Follow the Global Breaking News Network TikTok on Twitter. This is Bloomberg.